So let's get started talking about Fibonacci, a Fibonacci sequence and Fibonacci ratio, and how we would put this on our charts and you use it in our trading. Now tonight, I'm going to use the term security when referring to any tradable financial instrument. This includes stocks, bonds, commodities, futures, indices, mutual funds, options, etc. While I may imply a specific investment product, for example, I may say shares, which implies to shares or equities. These investment concepts will work with any publicly traded financial instrument in which an open market exists. It just gets very boring saying the same thing over and over and over again with the same term. Now, similarly, I'll mix the term investing and trading. Now, tonight we're all here from ETX. So basically, we are all traders because we're looking for short-term positions and short-term trades, as opposed to investing, which is a longer-term position. But in either case, the basic concepts and techniques presented in this class are equally adept. Now, tonight we're going to be talking about Fibonacci and the Fibonacci retracements, which are part of technical analysis. Now, some of the big questions that are raised are, should I buy today? What will the prices be tomorrow or next week or in an hour from now? Wouldn't investing be easy if we knew the answer to these seemingly simple questions? Now, if you're attending a class in the hopes that technical analysis has answers to these questions, I'm afraid I have to disappoint you very early. However, if you're attending this webinar with the hopes that technical analysis will improve your investing or trading, I have good news for you, it will. Now, we're going to start with the real bare basics of Fibonacci retracements and where Fibonacci numbers come from, how they're derived, and where these ratios come from. Because remember, Fibonacci was not developed for the financial markets. Now, Fibonacci retracements are ratios used to identify potential reversal levels. These popular ratios are found in the Fibonacci sequence. The most popular Fibonacci retracements are 61.8 and 38.2. Now, I know a lot of you guys are sitting out there saying, wait a minute, what about 50? But the fact is 50% is an extremely popular retracement level. And it actually comes from Dow theory. And it has nothing to do with Fibonacci's, except since it's such a popular retracement, it's been added into the Fibonacci retracement tool. Now, Fibonacci retracement can also be applied after a decline or a rally of a price. And it measures the bounce of the trend from the previous trend. These retracements can be combined with other indicators and price patterns to create overall strategies. Now, the thing is, most people don't know where these ratios, or where this 38.2 and the 61.8 come from. Okay, so let's go back to the beginnings and let's understand where these fibs come from. It's not very complicated, but it's important you grasp it. Everything started, my computer's going a little haywire here. I got a brand new computer today, so everything has just got loaded in. And so if anything goes crazy, we'll get back to normal. Don't worry about it. Okay. Now, the Fibonacci sequence starts out with a 0. Then we add a 1 to the 0. The 0 and 1, the two previous numbers added together, 0 and 1 give us 1. Then the two previous numbers, the 1 plus the 1, give us 2. If we take the 1 plus the 2, it's going to give us 3. 2 plus 3 will give us 5. 3 plus 5 will give us 8. 5 plus 8 will give us 13. And this will go on into eternity. It goes on to infinity. It goes on forever. Now, the fact is, that you're doing this sequence, or I'm doing this sequence, or somebody in Russia's doing this sequence, somebody in China, is all the same numbers. They don't change. They are finite. 0, 1, 1, 2, 3, 5, 8. And you can always calculate them as much as you want. They get very big as we go farther out, but they're always just a previous number added to the current number gives you the next number in the Fibonacci sequence. And this is just called the sequence. Now, the sequence extends into infinity and contains many unique mathematical properties. But coming up with the ratio isn't so complicated. It's a little bit mind-boggling, but it's not so complicated. So remember, we talked about the 1 plus the 2 gives us 3. The 2 plus the 3 gives us 5. The 5 plus the 8 gives us 13. Now, these are just numbers in a sequence. How do we make these into ratios that apply to things in the universe? So the first thing we do is we take, and we're going to use right now this string. And then we're going to take this string and we're going to take it one step farther, which would be the 13 plus the 21 gives us 34. And then the 34 plus the 21 gives us 55. Now, what we do at first is we will take any numbers in the sequence, but in this case, we're going to take 21, which is this number here, and divide it by its previous number in the sequence. Whenever you do that, you're going to come up with a number that's approximately 1.618. We go over here to 21 and 34, it comes up to 1.619. So the approximation is always 1.618. This is really the maximum Fibonacci number, and it's really considered a Fibonacci extension, which we'll get into shortly. But once we go from there, we can take the 13 and the 21 sequence, and what we do is we go take the 21, we reverse the division. We take the 21, the 13, and divide it by 21. So we take this number and divide it by the next number. And that's always going to give us a number around 618 or 619. Now, Fibonacci numbers, we've come up to 618 and 1618, 0.618, and 382. They are just approximations. And remember that there. So when you put these fib levels on your grid and on your charts, don't get yourself locked in to this finite exact numerical value. Okay? Think of them as zones. Now, so right now we use one number and divided it by its previous number. Okay. If we go one step farther, and go back and take this 13, and 13 plus 21 gave us 34. If we were to take the 34 and go back two numbers, which takes us to 13, and divide the 13 by the 34, it's going to give us 0.382. Now, the funny part is if we were to take the number 1 and subtract 618, guess what? We get 382. We can go one step farther in Fibonacci, which gives us the 0.236, which is by going 3 digits back. And you'll find out that these numbers, like I said, are, so this was give us our 23.6 retracement, which is considered a shallow retracement. There are infinite numbers or a combination we can consider Fibonacci's. There's a 75 level, all 75.6 level also. But the most popular are these numbers: 1618, which is an extension, 618, 382, and 236. And you see they all come from simply moving one sequence over and dividing it by the previous sequence. One sequence over and dividing it by the previous sequence. So it's not a very complex mathematical formula. Yes, we could write it out in some great big long algebraic formula to get this, but as you can see, it's not so complex. Yeah, you'll never have to calculate it. I'll never have to calculate it. We'll never do it. But the 1618, which I told you was an extension, is referred to as the golden ratio or the golden mean. It's also sometimes called phi. The inverse of 161.8 is 0.618. Now, these ratios can be found throughout nature, architecture, art, all over the world. They're actually the proportion between your ears, nose, and mouth on your face. The proportion of 0.6180 to 1 is the mathematical basis for the shape of playing cards, for the Parthenon, for sunflowers, for snail shells, for shells you find on the beach with the spirals going through them, for Greek vases, and also the spiral galaxies of outer space. Why they all have these numeric values, I have no idea. The Greeks based much of their art and architecture on this proportion, and they called it the golden mean. In finance, we don't call it the golden mean, we just use them as retracement levels. So assets will often pull back or retrace a percentage of the previous move before reversing. So in other words, if an asset had rallied up from 0 to 100, when it's retracing back down, okay, it will most likely retrace down 38.2, 50% or 61.8 of that previous move. Now remember, actually the 50% level really does not have anything to do with Fibonacci. But traders use this level because the tendency of assets to reverse after retracing half of the previous move. So as we saw here, after a stock makes a move up in side A, it will then retrace a part of that move B before moving back again in the desired direction. You see, asset pushes up. It retraces back 38.2% of this move. But it could go farther and go down to 50% of that previous move, or it could go all the way down to 61.8% of that previous move. Okay. Now, each of these are alerts or zones. Now, 38.2 is a very common zone, 50% at 61.8. Okay. Now, it's very important to know that when an asset is moving, okay, and you need to know whether it's retracing or it is reversing. Okay? Because if it's a retracement, you don't want to panic and get out of the market. Or if you're looking for an entry point to enter the market, you want to see what happened at that 38.2 level and did the price bounce off of there? Maybe it's going to continue its rally and you'll enter the market there. Okay? It might come down to 50%. Okay? And so all of these are alert zones. They're zones that you should be aware of and watching for price. You could also use these zones to set your stop losses and your take profit points. Okay. So once an asset begins to pull back or retrace, then you can plot these retracement levels on a chart and look for signs of reversal. You do not automatically buy an asset just because it's at a common retracement level. You look for candlestick patterns develop at that 38.2 level. If you don't see any signs of reversal, then you go to the 50% area, look for a reversal. So let's talk about how to put these on our charts, because they're not very complicated to put on our charts either. We simply use the Fibonacci tool. And the Fibonacci tool will pull them right onto our chart. So in order to find these retracements, okay, you have to find a recent significant swing high and swing low. Okay. And you need to find a trend that has ended. You're not using the current trend, you're using the last uptrend or the last downtrend. So let's go over to some live charts, and then I'm going to show you a short little clip that will help you see how to use this on the ETX platform also. Okay, well. Okay, so let's take a look at some assets. We're looking. I'm sorry. Should have bought it. There we go. So we're looking for an asset that is making a strong move. Okay. It's driving me crazy. I've already signed in these twice already tonight. Sorry about that, but we'll get him in place in a second. Okay, so let's find an asset that's made an interesting move. Okay, we're looking at Bitcoin US dollar for no reason whatsoever. Okay, all I'm looking for is I'm looking for an asset that has well, let's see. That one's not going to, I'm just looking for one that's easy to work with on class. Okay, let's get rid of my MACD down here. Okay, so we're looking at crude oil. Okay. I'm only looking for something easy to draw in class. So what we've identified is we need to identify the end and the beginning of the previous trend. So we can see crude oil is currently trading in an overall uptrend. We can see the previous downtrend here. Now, what we need to identify are the significant swing high and the significant swing low. Okay. It's the beginning and the end of the previous trend. But we want to ignore anything that was out of the ordinary that jumped down and price hit an extreme low because something caused some volatility for a second. Okay, in this case, here is our swing high, and here is an excellent swing low. Okay, you can see the candlesticks. Okay, both support the. We have a bearish candlestick pattern and a bullish candlestick pattern. So we have a pretty good swing high and swing low. Now, so for downtrends, click on the swing high and drag your cursor to the most recent swing low. If you're drawing the fib on an uptrend, you do the exact opposite, but you have to pull them in the right direction because you don't want the 38.2 calculated upside down. So if we're viewing it on a downtrend, we're simply locating the swing high and the swing low and pulling it down. Downtrend, pull down. Rally up, swing up, uptrends, pull up. Okay. So we're going to go over here to our tools, and we're going to locate our Fibonacci retracement tool. And then we're going to go right here. Okay. Now, let's try it this way. I think it was overlapping a couple things there. It wasn't letting me draw it on there. So, and you want to make sure you pull it forward to the edge. So we can see right here, we pulled it on here from the 1 all the way down here to the 0. We can see our 23.6 retracement levels here. Our 38.2 is here. Our 0.50 is here. Our 61.8 here, 78.6, and 1. Now, I've got mine set up in rainbow colors. You can do whatever you want on however you want to set them up. You want to set up blue lines or red lines. You want to set up only red lines. You decide what's comfortable for your visual. Now, having the color lines is not necessarily important. Okay. Now, I'm going to show you how to do them, or how to do all the technical indicators on the ETX platform. And then we're going to come back to actually applying these and using these. Okay, ladies and gentlemen, so now that you know how to add the indicators using our Trader Pro platform, we're going to go back over and continue using the charts that I use for class on TradingView. Now, one of the people will ask me, why do I use TradingView and why should you use the ETX Pro charts? TradingView offers a free subscription. They also offer an inexpensive subscription after that, and then they offer a high-grade traders plan. Most of the importance on charts are about feeds and how fast the data is being fed into the charts. Because feeds and data flow is very, very, very expensive. So the fastest you're going to get will be directly on ETX because they're giving you up to the second live rates because they're giving you the live rates to quote you the prices anyway, and they're getting the direct instantaneous feeds. If you're using free charts, they usually have anywhere between a 5 and a 15-second delay. Not because anybody's trying to scam you. In fact, most of the charts will tell you on there that it's got a delay. It's just the data for the feeds, the cost of the feeds becomes, I mean, the drop is like buying a new car off the showroom floor and buying a car that somebody bought a week ago. The price drops tremendously. And so most of the free charts use wherever at least the price are. And sometimes if you go back, if you're using dailies and go back, the previous day, or go back, to the opening of the day, they're almost free. Okay. So remember when you're using charts, a big difference is how fast the data is being fed. So you should always use either a charting service you're paying for and probably paying a top rate, or the charts on the platform because they're the most up to date. And you don't want to miss a trade because you're getting 15-second delayed data, so you miss an open. Okay, so just keep that in mind. Now, we've laid on here our Fibonacci's. And this is a classical one. As you saw, I was thumbing through all of those assets, just looking for something that I could see had an easy rally that we could draw these from. But now that we've drawn these on our charts, look at what happened at the 61.8 level. Now we drew this from here to here, but let's look at the most current trading levels and look at what happened when that asset moved up to the 61.8 level. It fell off there and came straight down to that 50% level and then moved straight back up to that 61.8 level. When we saw it coming through and moving up, price moved up to 23.6, came here and stalled for a second at the 38.2, moved up to the 50, bounced off the 50, wasn't able to come back down and violate the 38.2, moved back up and moved straight up to that 61.8 level. So you can see that these are not things that are made up. These are truth in action. Okay, and this is the most current price of U.S. oil. So let's go back to my PowerPoint for a second, and then we're going to take a look at a short little thing on how to use fibs. Okay, so now we've seen we pulled this down. It was in a downtrend. We pulled the fib grid down. In an uptrend, we do the opposite. Okay? We locate the strategic or the important swing high and the swing low. Okay, just because of price somewhere down here suddenly fell down here and then moved straight back up and then parlayed around here. You need to find one, okay, that is significantly important, as well as look for some type of a bearish or bullish, depending on top or bottom, signal in your candlesticks or some other reason that you know that that's the end of that previous trend. Here's just the opposite when we locate the swing high and move to the swing low. Now, in order to apply Fibonacci levels to your charts, you'll need to identify swing high and swing low points. Okay, a swing high is a candlestick with at least two lower highs on both the left and the right side of it. That's a good way that you might want to define it. A swing low is a candlestick with at least two higher lows on both the left and the right. When using the Fibonacci tool, the probability of Forex trading success could increase when used with other support and resistance levels, trend lines, and candlestick patterns for spotting entry and stop loss points. Okay. Now, finding the swing high and swing low are personal. They're not out there that you can just do these on your own, but there's no finite definition. So you and the guy across the street could be using slightly different swing highs and swing lows. This is to make a difference in the calculations. So that's why I said earlier to imagine these as alert zones. Retracement levels alert traders or investors of a potential trend reversal, a resistance area, or support area. Retracements are based on the prior move. A bounce is expected to retrace a portion of the prior decline, while a correction is expected to retrace a portion of its prior advance. Once a pullback starts, charters can identify specific Fibonacci retracement levels for monitoring. As the correction approaches these retracements, charters should become more alert for a potential bullish pullback. Alert, zone, keep those in mind. Okay, it's very important that you don't get stuck on these define for sure numbers. So let's share this Okay, so the truth is, just like in combining the Fibonacci retracement tools with support and resistance trend lines and candlesticks to find a better entry, it would be best to use your knowledge of these tools to analyze the current environment to help pick stop loss as well as take profit points. As much as possible, you shouldn't rely solely on Fibonacci levels as support and resistance points as the basis for a stop loss placement. Remember, stop loss placement isn't a sure thing, and neither is take profit points. One of the best tools I find to combine with fibs is look at volume. Okay, volume will help you know where the traders are or how the traders are reacting to each one of these levels. Okay. Fibonacci retracements are often used to identify the end of a correction or counter trend bounce. Corrections and counter trend bounces often retrace a portion of their prior move. So remember, while 23.6 retracements do occur, it's the 38.2 to the 61.8 covers most of the possibilities with 50% in the middle. This zone may seem big, but it is just a reversal alert zone. Other technical signals are needed to confirm a reversal. Reversals can be confirmed with candlesticks, momentum indicators, volume, and chart patterns. In fact, the more confirming factors, the more robust the signal. So hopefully you learned a little bit about fibs tonight and try to incorporate them in and just think of that as support and resistance levels. So you have fibs that will give you these support and resistance levels. You have eyeballing, you have